Hello and welcome back again. Here are some small remarks concerning some widely discussed tax saving models in connection with dividends and shares and so. And well, you have perhaps heard of CumEx constructions or things like that, sometimes very, very famous, or treaty shopping constructions. And so let's again have a look on the rules in the OECD model which we have been confronted with. The OECD model contains an own article on capital gains, so on the gains which result from selling an asset. Now we have already talked about that basic content of that rule in a previous video. However, there are some parts which still deserve a comment. Selling shares. The right to sell to tax the gain from selling shares is given by the OECD model to the residence country of the taxpayer exclusively. In Article 13, usually it's 5, although the paragraph number varies from time to time. Now, there is a rare exception that sometimes also the company, the country of the company can levy tax on selling shares, but that is only in cases where the company mainly has property which is immovable property in the other country, so mainly if we have to deal with already something which is a kind of a tax saving model. However, whenever you have a regular company, then the shares can be taxed only in the country where the seller resides. However, the right to tax the dividends which flow from the shares during the time when the owner possesses the shares is split between the source country and the owner's country of residence. You remember that Article 10, 1 and 2. The source state can levy a withholding tax. That's just what we recently discussed. Now, economically, selling the shares and collecting the dividends year after year is absolutely the same, because the price for an asset is nothing else than the discounted, so interest-corrected present value of all expected future revenues flowing from it. So economically, we have two different tax regimes for absolutely the same thing. Two equivalent economic behaviors: selling the shares for today's value of all expected future cash flow, or taking the future cash flow one by one, then for a slightly higher money value, which then reflects the interest which you deserve for waiting until then. That's extremely equivalent, and you have two different tax regimes for two equivalent things. Naturally, that invites tax saving measures. If you are taxed in two different manners according to what you do, although what you do is economically completely the same, then that gives you a strong incentive to make a choice. And to opt for the better of the two alternatives always. That's natural and quite unavoidable. You pre-program such a behavior. So the present regime in the OECD Model Convention gives you a choice. As the owner of shares, you can practically choose either to collect dividends year after year and then give a tax to your state of residence plus to the state of source under Article 10, 1 and 2, or to sell the shares and pay taxes only to your state of residence. And as we can see now, it's highly plausible that the second alternative might be more attractive, because here you see the first one is pay tax to your state of residence, and the second is also pay tax to your state of residence. The difference is pay tax to the state of source or don't. So probably how you exert that factual option strongly relies on the economic impact of that source state taxation. So especially when the source state tax cannot be fully credited in your state of residence, so that it has an economic impact for you, and you will try to avoid it. That might be the case in general, or the risk that you can't fully credit this will be increasingly high if the tax on the shares in the state of residence is very low. It might be, for example, when you have a constellation that collecting the dividends in your state of residence also triggers a tax, perhaps even a high tax, so that you can credit the source state tax. But if selling the shares then costs zero, then naturally you would say, that's the most favorable tax regime. I want to opt for that. So I want to sell the shares. And so in these two situations, you would try to replace the regular flow of dividends by selling shares. So one might now draw the conclusion that the rules of the OECD model convention pre-program a behavior that people rather sell their shares than collect dividends in order to avoid the tax burden of the source state, wherever that tax burden of the source state has any economic impact for them. Now, as selling shares and collecting the dividends year by year is economically perfectly equivalent, one might even create intermediate behaviors which combine the two elements. For example, you might sell the shares before the dividend is paid out, so that somebody else now receives the dividend during the time when that somebody else holds the shares. Preferably, that should be somebody who does not care about the source state withholding tax, because he, she, or it can fully credit this payment to its usual tax burden. And then you rebuy the shares from that person, and then you start the cycle anew when the next dividend comes. That would also theoretically be fully possible. How would that work? Imagine that you have a company A which will pay out a dividend of 100 on the 1st of March 01. The present market value of the share shall be 400. That automatically implies there will be 100, the value of the dividend which is still to come, and the remaining value of the firm, 300, by assumption here. After the dividend has been paid out, the value of the shares will then drop immediately by these 100, so to 300. Now, the foreign shareholder, let's call him FS, owns these shares and sells them before the dividend is paid out. Now they have a price of 400. They are sold for 400, so FS makes a gain from selling. This gain is only taxable in the home state of FS, so no state in the tax in the source state. Especially when selling the shares is highly privileged there, let's say no tax at all under 8B2 KSDG, or a partial tax exemption under the 60/40 rule, or a low tax rate which you usually can't profit from, lower than for collecting tax dividends. All that pre-programs that. So the new owner of these shares has acquired them now for cost of acquisition of 400. The dividend comes, which triggers current revenue. So we have the following posting: the bank account receives 100, and it's a revenue from dividend income. At the same point, the market value of the shares drops down by 100, which entitles the new owner to book an impairment. So we have expense, and the value of the shares goes down. If you are not entitled to book this impairment, you could realize that loss just by selling the shares a month later for the value of 300. Then you have a loss from selling them, so it's all the same. Now, in the next step, this new owner can sell the shares again for the new market value of 300. For him or her, it's now neither gain nor loss, because book value is 300, sales price is 300. Perfect. So for this intermediate person, no gain, no loss. Naturally, perhaps you give him a bit of a profit to make it interesting, but In principle, that works this way. Now the buyer of these shares is again the previous owner, might be at least. So he rebuys them now for the price of 300, and the cycle can start anew. The value of the shares rises over time due to newly made profits of that company. The company announces that the dividend again is to come, and then you do it again. This behavior is nothing else than the basic principle behind these famous cum-ex transactions. So you play ping pong with the shares, sell them, rebuy them, and take great care that the dividend always goes to people where the source state tax has no real effect. And so somebody, let's say a foreigner, completely avoids the source tax on dividends under Article 10.2. Now, the important thing which you must clearly see is that this abusive or even criminal behavior is clearly built into the system, because two equivalent economic alternatives are treated differently under the rules of the OECD model. That can't work. And where a system is economically nonsense, you can't wonder and cannot be very surprised if later the system produces nonsense in reality. What is now the most surprising thing is these effects have already been laid out and prognosticized in literature 30 or 40 years ago, at least, if not far earlier. And what is so very surprising is that this nonsense solution is strongly defended still by all our lawmakers, and they undertake even the most desperate steps to defend it. So to draw lines between what is a legitimate case of selling shares and when should somebody collect a dividend and pay a withholding tax. And that's especially so surprising because everybody knows that in the financial markets you have professionals, thousands or even 10,000 of them, fully trained on seeing the slightest possibility for arbitrage gains and arbitrage profits. So especially trained on seeing that two things are economically the same thing, and when you construct behavior a bit differently, then you have a higher net outcome. And that's a question of common sense. If you see that these people are so highly trained, that it's also very usual, it's not even an unusual behavior, it's even proper dealing with financial investment. To find arbitrage things, and this is how the markets work, and to forbid this would probably have huge implications for the proper functioning of financial market. Knowing all that, it's really interesting that we still try to defend the undefendable. So in that context, what is also surprising is that we have other cases concerning dividend taxation, where the same thing, paying out dividends, is treated differently. Again, we see the markets react, or the tax planners react. When dividends are subjected to a withholding tax, we have totally different cases. We tax some dividends with 5%. If the shareholder is a parent company, having a higher participation, or even 0% or 2% or 3%, whatever is negotiated. Then there is another class of shareholders who is taxed with 15%, the regular rate for the usual shareholder under Article 10.2 OECD model convention. And the third class of shareholders is those who are subjected to the full regular national withholding tax rate. In Germany, that would be 25%, because they live in a country where they are not entitled to benefit from a double taxation treaty. So paying out dividends, the same thing, is completely differently treated depending on who gets these dividends. So naturally, you can also decides that this will be the starting point for arbitrage procedures. So one will take care that the recipient of the dividend will be the person in that country um, which has a right to the most favorable double taxation treaty conditions. So you automatically cause something which could be called treaty shopping. Also, there will be people who say, I expect the dividend to come, I have only 9% participation. If it were 10% on the day when the dividend comes, then I would be better off. So let's buy the missing 1% in the stock exchange, collect the dividend, and later sell again back the unnecessary 1% via the stock exchange to the general public. That is entirely foreseeable. So all that comes simply from the decision of our legislators to treat economically equivalent things differently depending on what you do, different treatment of gains and current revenue, and to make some distinctions in the treatment of the dividends or depending on who gets them. All that is a programmed road to problems. So to sum up the difficulties a bit, you can make a list. The withholding tax of the source state can easily be replaced by a sell the shares model and is therefore economically doomed and defendable in the long run. The withholding tax on dividends is often different depending on whether you pay it to a person in a state with a usual DTT, with a very favorable DTT, or to a state without any DTT. So that leads to, I want to have a dividend recipient in the most favorable state, so that leads to treaty shopping. And then you also have the withholding tax. It has a different level depending on how high your participation is, sometimes 5%, 0%, 15%, and so on. And as you can vary this, people will vary it to have the most favorable condition at the moment when the dividend comes. All these behaviors can be observed in practice, or they are classified as abusive when the fiscal administration sees what happened. And they have other constellations where they say, yeah, here's a change of the owner, the recipient of the dividend is just a normal behavior. There they accept it. So the fight against these things is also necessarily arbitrary, because you have to decide, is it something which people did in order to lower the tax burden, or did they just lower the tax burden because they were idiots and just by chance did the thing which was favorable for them? This is not a very good criterion to design a tax law, that you only have a favorable tax outcome if you just happened to do things because you were an idiot and didn't understand or aim at this favorable outcome, whereas those who understand and aim at the favorable outcome are denied the favorable outcome. It's highly arbitrary. So also the defense against these things is usually complicated and basically arbitrary. So all these problems are necessarily, and in the last consequence, the built-in consequence of setting up a system which treats economically identical or highly comparable things completely differently, treating dividends differently from selling the shares, treating dividend payments to A different from paying the same dividends to B, or treating dividends from 30%, 20 or 25% participation differently from dividends from a small portfolio participation. All these problems will only vanish if one decides to treat dividend payments equally in all these situations. So, what would that be? Yeah, with no withholding tax at all, because there is at least one alternative, the sell the shares alternative, where there is no tax given to the state of source. And if you remember what we said when we talked about the rules for the Article 10 and its theoretical background, then our first alternative is the source country should not get a tax. The second one is it should go to the state of residence, and then as a compromise, okay, if the source state wants a bit of the prey, then we should take a small tax. That was in principle a breach of the fundamental logic. There was really no compelling logic behind that. Source state should also get a bit of the money. However, that logical breach which entails all these problems. So basically, all these problems will probably vanish when states get clever and say, okay, withholding tax on dividends paid to people, to foreigners or so, which is definitive, is undefendable. Okay. And there are states who did that step. For example, the United Kingdom is one state where I know that they don't take a withholding tax on dividends. Might be a creative outcome and solution of that problem. Other states defend the undefendable and hope that probably if you just fight the taxpayers' intelligence in the most creative way, that then you might succeed and you keep a bit of the money. And so tax law gets more and more complicated due to this, let's say, inconsequent behavior when you design a system. Naturally, what can't work will not work. This is a very plain insight, but it's very difficult to communicate to people who design a tax law. Okay, this was today rather a short one, but it should be enough for today. So thank you for listening and goodbye till next time.